I'm going to try and say a word on air that should never be mentioned. Methodological. Yes, did it. Methodological changes made the January non-farm payrolls figure complicated. So, January's non-farm payroll was a whipsaw figure for market watchers. The headline number came in at 130,000. That is the strongest growth in more than a year and more than double the 55,000 that Dow Jones had predicted. But job creation for last year was revised dramatically lower to just over 15,000 per month, with the last 6 months of the year, producing a net loss of 1,000 jobs. Now, the two-year Treasury yield posted its biggest one-day gain since late October on the back of the news. But as I say, there were methodological changes that made it more complicated. Meanwhile, the unemployment rate dipped to 4.3% against expectations. It would hold at 4.4%, potentially shifting focus back to the inflation aspect of the Fed's mandates. I got methodological. I couldn't do expectations. Anyway, expectations for a rate cut at the central bank's next meeting slumped on the back of the data, according to the CME's Fed Watch tool, which now prices in a 1 in 20 chance of a rate reduction versus a 1 in 5 chance on Wednesday. We've spoken to investors and economists about the outlook for the Fed from here.
Our forecast, we don't get any cuts until the middle of the year, but then we have 50 basis points as inflation starts to come down more clearly when we lap the tariff effects in April, May, June. Then in the back half of the year, we think inflation is going to come down, and that will create room for sort of benign cuts back down to the 3% estimate of the neutral rate that the Fed has.
One of the best trades out there right now is betting on more cuts this year than expected.
Which you did last year successfully, too.
Yeah, we've had this on for a bit, but I really think that he's not being brought on to hold the rates at a steady rate. If we have 4 or 5% inflation, sure, then he won't be able to persuade people. But otherwise, he's going to argue productivity. He's going to argue we don't have to cut just because the economy is running hot. I mean, we can cut even if the economy is running hot. And so I think by the time we get to the end of the year, it's going to be substantially more than 2 cuts.
We expect 2 cuts this year under the new chair. We think Jay Powell is done in terms of rate cuts. But I think the data is poised to essentially give the chair what he needs to persuade the committee to cut a couple more times this year.
Well, I said it was complicated, and fun enough, I was looking at Jan Hatz's research, who was just talking about it there as well. But let's get another view. Jason Granite is a CIO at BNY. Methodological changes meant the street was all over the place on this one. What do you make of it, though, Jason?
I'm impressed with your pronunciation.
Yeah, I couldn't get the word expectation out there.
No, well, but speaking of expectations, obviously the market was expecting a weaker number. There's been a lot of focus on the labor market across policymakers. From my seat at BNY overlooking our balance sheet, we're very focused on the direction of travels of rates. The labor market has been the focus. I think even with this report, we're tracking something like 75,000 jobs over the last 3 months on average, which is above what most economists would say is what we should expect in kind of this new normal, given the immigration story. But I still think we're balanced between labor and inflation, and we might have here shift off the complete focus on labor.
Jason, it's all to play. It's actually quite an exciting movie at the moment. And the other story that I was really interested in yesterday was the non-partisan Congressional Budget Office, which again is another great big mouthful, who basically said the deficit is looking horrible and it's going to get worse to 2036. And of course, Kush Desai, the White House, is saying you got your growth figures wrong. So how much is everybody looking at that side of the budget, the ledger as well?
Yeah, I think this has been a big focus for a long time. I continue to be impressed with your word salad there. But look, some of the rocks that we see in investing one of them is this fiscal story. Central banks have gotten out of the business of holding and warehousing a lot of bonds over the last handful of years. Their balance sheets have come down. So the focus is on where all the fiscal goes.
Jason, it's only $6 trillion now or something crazy, isn't it? well, I guess my point is, what's Warsh going to do on that?
Look, there's a long way to run here before Warsh is in the seat. I think there's different ways in which you can have a smaller balance sheet or think about the balance sheet. Number one is you can think of the balance sheet as a percentage of the economy or GDP. And if GDP is growing at the clip that it seems to be growing and the balance sheet isn't really changing, then by default, it's shrinking in some capacity. The other way is, right now, the portfolio that the Fed owns, most people don't know this, but it actually has longer duration than the average outstanding U.S. Treasuries, across, if you compare like for like. And so if they roll into T-bills and they get shorter, and the economy grows, and they keep the balance sheet growing at a slower pace through these reserve management purchases than the economy's growing, then you have a smaller balance sheet as a percentage of the system, and you have one that is a shorter duration than it was before. And so, most people get kind of tongue twisted, as you are, with smaller balance sheet, meaning they have to sell or do something, and we just don't see it that way.